Are you hungry for the latest news and trends from the internet? Welcome to What's Cooking on the Internet, your one-stop shop for discovering the hottest digital delights. Hit that subscribe button and let's get cooking.
As we hit the midpoint of 2025, investors are left wondering what the rest of the year has in store for the U.S. stock market. Will the second half be a wild ride or a steady climb? Keith Lerner, co-chief investment officer at Truist, thinks we're in for a mix of both. Lerner points out that while the technical picture looks good, valuations are getting a bit too high and seasonal volatility might test investor nerves before year-end. I think the bias is still high, he says, but we need to be careful and not get too caught up in the hype. This is especially true since the S&P 500 is trading near 22x forward P/E, which is near the top of its range from recent years. Despite the tech gains, markets have been stuck in neutral for 7 months, and Lerner says investors should do some gut checks along the way. Long-term investors should stay in the market, but keep their expectations in check, especially when valuations get near their ceiling. As softening Fed, steady economic data, and strong earnings from key sectors still make the bull case look solid. One area that Lerner is really optimistic about is growth areas like tech, semiconductors, and communication services. He's also starting to add a bit more international exposure to the mix. However, he warns that investors should be prepared for a bumpy ride, especially in August and September, which tend to be tougher months. But what about the impact of geopolitical uncertainty on the market? Lerner notes that while tensions in the Middle East are ongoing, investors might be overestimating the impact on the market. According to a new Barclays report, spikes in geopolitical risk have had little observable impact on U.S. equity returns over the past 3 decades. In fact, the S&P 500 has historically shrugged off periods of unrest, with 6-month returns staying largely in line with long-run averages after spikes in risk. At the sector level, industrials tend to outperform after geopolitical shocks, while energy stocks typically lag. This might be unexpected for investors adopting a defensive strategy, but it's a reminder that geopolitical spikes are rarely a reason to abandon equities. So what can we expect from the second half of 2025? While Lerner thinks the bias is still high, he cautions that we should be prepared for a mix of both volatility and growth. Long-term investors should stay in the market, but keep their expectations in check and be prepared for a bumpy ride. As we navigate the rest of the year, it's essential to stay informed and adapt to changing market conditions.